Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Accenture stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 204 billion market cap. They're trading at $326 a share and they have 626 million shares outstanding. Accenture specializes in information technology services and consulting. It offers application services including agile transformation, DevOps, application modernization, enterprise architecture, quality engineering, data management, intelligent automation comprising robot process automation, natural language processing, and virtual agents. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really consistent free cash flow between 8 and 9 billion a year. Their margins are okay, 13%. That means they convert 13% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That goes up each year from 6 billion to 7.1 billion. Margins around 11 to 12%. Revenue is a sales for the company and they generate a lot of revenue, 50 billion up to almost 65 billion. They do pay a dividend, a 1.6% dividend, and they cover it 2.5 times with their free cash flow, because it cost them $3.3 billion to pay the dividend and they generate $8.7 billion of free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's $222 billion. We discounted those numbers back to today using a weighted average cost of capital. We got a value of the company of $197 billion. We divide that by 626 million shares. And we get a calculated stock price of $315. They're trading at $326, so they're trading at a 4% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 59 companies in the same industry as ACN. If they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $500 million in CapEx, more than the median, a lot less than IBM and Fiserv. A good debt to equity ratio, 0.2 for every dollar of equity, they have 20 cents of debt. They do pay a 1.6% dividend, which is equal to the median. They generate 8.7 billion of free cash flow, second on this list. They're the biggest company on this list, bigger than IBM. IBM has been around over 100 years. All their price multiples are worse than the median, but not that much worse. Their PE and price to free cash flow are better than the average. They seem a little overvalued according to their price multiples. They generate the most revenue in this industry, 65 billion, and they are still growing. Their 5-year annual revenue growth rate is 9%. Globant is the biggest, 32%. Here's their latest income statement, the 3 months ending 5/31/2024. Revenue is down, was 16.6 billion, now it's 16.5 billion. All the expenses directly tied to generating revenue is 11 billion, marketing 1.8 billion, G&A 1 billion. So operating expenses 13.8 billion. So they did lower their operating expenses, which gives them higher operating income. So that's a good sign. Lower revenue, but higher operating income. They received 54 million of interest on their cash. They paid 11 million of interest on their debt, 670 million of taxes. So their net income 1.9 billion, last year 2 billion. They did decrease their shares outstanding. It went from 631 million to 628 million. And EPS is down a little bit from 318 to 307. Of the 307 of EPS, they pay out $1.29 of dividends per share. So to summarize, I have them trading at a 4% premium. I rank them 8 out of 10. Would I buy them? 8 out of 10. I like investing in winners, in good solid companies. And I probably want a little more of a pullback. But if it's a long-term investment, I think pretty much any time is good to go in on the stock. Ratio is 5 out of 10. They're about average. Maybe they should be 4 out of 10 actually. Financial 7 out of 10. It would be higher, it's just their free cash flow hasn't been growing, only up 3% since 2021. Revenue is growing, up 28% in the same time frame. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking a link in the description below. Thanks for watching.